Hi, good morning, everybody. This is lecture for week 9, lecture 1, Monday, 20th of December. This week we will see, I will cover topic 7, which is about cost accounting. Actually, this topic is introducing you to management accounting. Topic 1 to topic 6 are topics related to financial accounting. And then topic 7 to topic 11 are topics related to management accounting. Okay, remember this. When you learn about financial accounting, the purpose of doing financial accounting is to prepare financial statement, and the financial statement is used mainly by external users. People who wants to see whether the business is making profit or not will use financial statement. But remember, management accounting is the type of accounting that you do for the purpose of providing information to managers to make business decision. So manager is the main user of management accounting output or information. So before you learn about management accounting, you have to know the output of management accounting is mainly for managers to make accounting decision. So you have to know what are the function of managers, or what are the works of management. So let's see. Managers, they have 3 main activities. The first one is planning, the second one is directing and motivating, and the third one is controlling. So let's say in the future you are working as a manager, so most of the time you have 3 activities to do or works to do, which is planning, directing and motivating, and controlling. So let's see the detail about each activity. Okay, what is planning? Planning is charting purpose or things to do for a business in the future. So these are activities related to planning. First, identify alternatives, and then select alternatives that does the best job for furthering organization's objective, and then develop budgets to guide the progress towards the selected alternative. Okay, the second activity of managers is directing and motivating. So see, the first activity is planning, and then after the manager has planned, the manager has to implement the plan. To implement the plan, the manager has to do directing and motivating. Directing means the manager has to direct workers to do things according to the plan. And motivating is something like this. When managers work with workers or people, managers need to motivate the workers or people. People needs motivations. People or workers need motivation. If you are working with machine, then machine does not need motivation. But when you are working with people, you need to motivate them. Otherwise, productivity becomes slow, and you are not getting what you want from the people. So see the point that we have here. Directing and motivating involves managing day-to-day activities to keep the organization running smoothly. Things related to directing and motivating are employee work assignments, routine problem solving, conflict resolution, and effective communications. So managers has to assign people, has to solve problems faced by workers or people, and sometimes managers has to resolve conflict between workers, and also managers has to have effective communication with workers or people. Okay, the third activity of managers is controlling. See, there are 2 points here. The control function ensures that plans are being followed. Feedback in the form of performance report that compare actual results with the budget are essential part of the controlling function. So controlling is something like this. The main activity related to controlling is manager compare the actual results of his or her department with the plan. For example, a manager is a sales manager, then the plan or budget is to sell $100,000 in the month of December 2021. So controlling activity is something like this. At the end of the month of December 2021, the manager has to compare the actual sales and the budgeted or planned sales. Let's say the actual sales is 120,000. So when the manager compare the number with the budgeted number, which is 100,000, then there is no problem. The actual sales is greater than the budgeted sales. It shows that the manager performed well. But let's say the budgeted sales is $100,000, but the actual sales is $90,000 only. So controlling activity is done by comparing the actual sales and the budgeted sales. So the difference is 10,000 unfavorable. The actual performance or the actual sales is 10,000 less than the budget sales. So that is an unfavorable situation. So the manager has to investigate what is wrong with the situation, and also has to make correction. Okay, that is the thing related to controlling activity. So the activity of the managers can be described as like this figure in this slide. So it begins with planning activity. After the manager has planned for the business, the manager has to implement the plans, which is related to directing and motivating activity. After that, the manager has to do controlling activity. Controlling activity, like I said earlier, related to comparing actual data or actual results with the planned or budgeted data. So if the situation is favorable, then it is good. The manager will have to plan for the future again. But if the situation is unfavorable, then the manager has to investigate the reason and also has to do correction before planning for the next financial year. Okay, that are the activities of managers. So remember, management accounting provide information to help manager doing these activities. So the main information that can be used by managers to do these activities is the budget. Budget can be used when the manager do the planning, also can be used when the manager do the directing and motivating. Also, budget can be used when the manager do the controlling activity. Okay, what else? So remember another one. The person who do the management accounting is called management accountant. Okay, the person who do the financial accounting work, who do the debit and credit, who prepares the financial statement, they are called financial accountant. So there are many types of accountant. There are accountants that do taxation, so we call them tax accountant. There are accountants who investigate corporate crimes, we call them forensic accountant. So there are many types of accountant. The accountant that do management accounting work is called management accountant. Okay, so the next thing to know in this topic is the difference between financial accounting and management accounting. So you have learned about management accounting in topic 1 to topic 6. Now you are starting to learn about management accounting. So let's see what are the differences between financial accounting and management accounting. So I think the first thing that I want to explain is in terms of output. In this slide, the first point is users, but I want to explain about the output first. The output of financial accounting is the financial statement. So if you are a financial accountant, every day you do your financial accounting work, like record the transaction in the journal and then transfer the journal entries into the ledger, etc. So at the end of the process, the output of the financial accounting work is the financial statement. Okay, but for management accounting, the output is, there are two main output. The first one is budget. The second one is the cost report. If you are a management accountant, remember I have told you in the previous slide, if you are a management accountant, your main activity, your main management accounting work is to prepare information to the managers, so that managers can make business decision. So the output of the main output of management accounting activities or work, budget and cost report. Remember that. So and then, okay, the next thing, the second difference between financial accounting and management accounting. So the main user of financial accounting is the internal user. The main user of financial accounting is the external user. The people who will use the financial statement, remember the output of financial accounting is the financial statement. Who are the user of financial statement? The main user of financial statement is the external user. particularly the investor. Before the investor want to invest in a business, they look at the financial statement. If the financial statement shows that the business is not making profit, then the investor will want to invest. Other external users are like tax authority, creditors, lenders, and there are several more. I think I have explained that in topic 1 or topic 2. Okay, that is the main user of financial accounting. But for management accounting, the output budget and cost report. The main user of this budget and cost report, or the main user of management accounting, is the internal user, particularly the managers. Managers will use the management accounting output. The management accounting output mostly confidential information. The budget and the cost report are confidential information. It only can be seen by the managers or people inside the business. So the main user of management accounting information is the internal user. You cannot allow people outside the business to see the budget and the cost report. It is the secret of the business. If you have your own business, you should not allow people outside your business to see your budget and cost report. That is your business secret. If other people outside your business can see your budget and cost report, they can use that info to beat your business. Okay, so that is the second difference. Okay, number 3. Number 2 in this slide, but number 3 in my explanation. Number 3 is time focus. For financial accounting, the time focus is the historical perspective. History. When you do financial accounting work, your focus is on the history or things that had happened. Remember, when you do the financial accounting record, you record things that had happened. Thing that has happened, that is the history. That's why we say that the focus of financial accounting is on the past or history. But when you do management accounting, most of the time the focus is on the future. You predict the future, you prepare the budget, you calculate the cost. When you calculate the cost, you use estimates. Most of the time in management accounting, we use many estimates. Okay, remember that. Point number 3, verifiability versus relevance. Okay, number 3 in this slide. Financial accounting emphasis on the verifiability. Everything has to be things that can be verified. Remember, when you do financial accounting, one of the things that you have to do is you record only data that can be verified. You record only data that has source document. You record only data that has receipts, invoice, or other documents. But when you do management accounting calculation or works, the emphasis is on the data that is relevant. You will see that in the later chapters. You will see that when you do calculation for management accounting, the focus is on the relevance. If the data is relevant, then you add in the calculation. If the data is not relevant, then you can skip that data. You don't have to use that data. And then number 4 in this slide, precision versus timeliness. Okay, for financial accounting, the emphasis is on the precision. Remember, when you do or learn about financial accounting, everything has to be accurate or precise. Everything has to be recorded in precision. If you record wrong number, your everything in your balance sheet and income statement will be wrong. You have to record exact number, otherwise your balance sheet will not be balanced. Your calculation of profit will be wrong. So it shows that when you do financial accounting work or record, everything has to be precise or accurate. But when you do management accounting, you will see that the emphasis is on the timeliness. Everything has to be done quickly. You will use estimates to make the calculation fast. This is because the user of the management accounting information is the manager. Manager has to do things very fast, very quickly. Otherwise, the business will not perform well. If you are a manager, you have to do things very quickly. So the management accounting work has to emphasize on the timeliness, to do things very quickly. Okay, number 5 in this slide is the subject. For financial accounting, the primary focus is on the whole organization. When you prepare the financial statement, you prepare the financial statement for the whole business. One business, one financial statement. But when you do management accounting, most of the time it focuses on segment of an organization. You will calculate cost for a product, or you will calculate cost for a department. You prepare budget for a department or for one product. So it can be like that. For management accounting, it can be focusing on segment of an organization. Number 6 in this slide, when you do financial accounting, okay, number 6 is related to GAAP or accounting standard. Generally accepted accounting principle or accounting standard. So remember, when you do financial accounting, you have to follow accounting standard. I think I have mentioned in topic 1 or topic 2. In Malaysia, when you do financial accounting record, you have to follow the accounting standard that we use in Malaysia. It is called Malaysian Financial Reporting Standard. But when you do management accounting work or calculation, you don't have to follow any accounting standard. The main reason is, remember, the output of management accounting is used by the internal user only. So you don't have to follow any accounting standard. You do things that is required by the main user of the management accounting information, which is the manager. Requirement number 7 in this slide, financial accounting is mandatory. Remember, I have told you, if for a company, it is required by law and regulation for a company to prepare financial statement. It is required by law and regulation. For sole proprietorship and partnership, they have to prepare the financial statement mainly because they have to calculate tax. Okay, so they are required by law and regulation. But management accounting is not mandatory. no law and regulation require a business to do management accounting. No, but the business will do management accounting because there are many benefits of using the management accounting information. The management accounting information, which are the budget and cost report, is needed by managers when they want to do their activities. But there are no law and regulation require a business to do management accounting. Okay, I think you have to remember at least 4 differences. 4 differences between financial accounting and management accounting. Okay, this is the next thing. When you do now you are learning about management accounting, and then like I said earlier, there are 2 main output of management accounting. The first one is budget, the second one is cost report. So when you learn about management accounting, the first thing that you have to know is about the cost. You need this knowledge. You have to have knowledge about cost, because when you prepare budget, that is related to cost, and also when you prepare the cost report, it is also related to calculation of cost. Okay, let's see. There are many type of costs. Okay, so the simple definition for cost is the amount that a business has to pay when the business is providing services or producing products. Let's say you have a business. That produces frozen food. Okay, so the amount that your business pay to produce the frozen food is called cost. So there are many type of costs. So let's see, there are several categories of costs. Okay, so when you do management accounting, most of the time the focus is on the manufacturing business. We focus on businesses that produce something. So here the first category of cost that you have to know is called manufacturing costs. Manufacturing costs are costs that a business has to pay when the business manufacture a product. So our example is, let's say you have a business that produces frozen food. So there are costs to manufacture the frozen food. Okay, let's see this example. Manufacturing costs also. So in accounting, the cost that a business has to pay to manufacture something are 3. The first is called direct material cost, and then the second one is the direct labor cost, and the third one is called manufacturing overhead cost. In this slide, the example is there is a business. That business produces sport car. See here, the very good red sport car. So in accounting, the cost to produce a product are called manufacturing costs, and there are 3 types of costs to produce the product. Okay, let's see one by one. Let's see what is a direct material. Okay, to produce a product, the first cost that will have to be paid by a business is called direct material cost. Okay, what what is the direct material? Direct material is the raw material that become an integral part of the product and that can be conveniently traced directly to it. So the simple definition for direct material is things that you can see in the product. So the example that we have here is a business that produces sport car. So everything that you can see in a sport car is called direct material. The amount related to direct material is called direct material cost. So if you look at this car, there are many direct material. For the example here is a radio installed in the sport car. That is one direct material. The cost of that radio is the direct material cost. You can see there are many direct materials here. The tires, the rim, the engine, the window, everything that you can see, they are raw material. The amount related to the direct material is called the direct material cost. So if you have a business and your business produces frozen food, everything that you can see in the food, the flour, the sugar, the what else, the butter, they are direct materials. The amount related to this sugar, flour and butter are called direct material costs. Okay. And then the second cost that a business has to pay when the business produces something is called direct labor cost. So, who are direct labor? If you have a business, there are many workers or labor. But who are the direct labor? So, see here. Direct labors are those labor that can be easily traced to individual unit of product. So direct labor, remember this, direct labors are workers who involved in the assembly of the product. Direct labors are workers who involved in the who are directly involved in the assembly of the product, of a product. So see here, in this example, the product is the sport car. Every workers that involved in the assembly of the car, that touch the car, that put something into the car, that assemble the car, are called direct labors. The salary that the business pay to these labors are called direct labor costs. There are many workers in a car factory. Imagine there is a car factory, and then there are workers who involved in the assembly of the car. But there are also workers who are not involved in the assembly of the car. For example, the janitors. Janitors clean the factory building, but he is the workers in the factory, but he does not involve in the assembly of the car. So janitor is not a direct labor. Another one is the supervisor, factory supervisor. Factory supervisor, he works in the factory. He monitor the workers, but he does not involve in the assembly of the product. So the factory supervisor most of the time is not a direct labor. Okay. And also, let's say the factory is a big factory, there are security guards. Security guards, he or she works in the factory, but he or she does not involve in the assembly of the product. So security guards are not the direct labor. So the salary of the security guards are not the direct labor cost. Okay, direct labor costs are salary of the direct labor. Okay, remember that. So if you have a business that produces frozen foods, your direct laborers are workers who involved in the preparation of the frozen food. The janitors, the security guards, the supervisor in the factory, the so these workers, they are not direct laborers. Direct laborers only people who involved in the assembly or the preparation of the product. Okay, the third type of manufacturing cost is called manufacturing overhead. Manufacturing overhead costs are costs in the production process other than the direct material costs and direct labor costs. Remember this. Manufacturing overhead costs are costs in the manufacturing process that other than direct material costs and direct labor costs. So manufacturing overhead costs can be divided into three types. The first type is called indirect material. The second type is called indirect labor. The third type of manufacturing overhead cost is called other costs. Other costs. So, what are indirect materials? Indirect materials are material used to support the production process. For example, lubricants and cleaning supplies used in the factory. So imagine in a car factory, there are many machines. Maybe robots are used to assemble the car. So materials like lubricants and cleaning supplies used in the to maintain all the machines in the factory, they are called indirect materials. The cost of these materials are called manufacturing overhead costs. Okay, the second type of manufacturing overhead cost is called indirect labor. Indirect labor are workers who work in a factory, but they do not involve in the assembly or preparation of the product. They are maintenance workers. Maintenance workers are people who maintain the machine, the robots, etc. And janitors and security guards, they are workers in the factory, but they do not involve in the assembly of the product or of the car. So they are categorized as indirect labor. The wages paid to these people are one of the manufacturing overhead costs. And then the third type of cost, the third type of manufacturing overhead cost is called other costs. This other cost has to be added in this lecture notes. So there are three types of manufacturing overhead. Other costs that are also categorized as overhead costs is things like rental, factory rental. You have a factory, maybe you have to pay rent. So the factory rental is not direct material cost, is not direct labor cost. So that is a manufacturing overhead cost. We categorize it as other manufacturing overhead costs. Factory rental, what else? factory building property tax. What else? Another one is depreciation of the equipment in the factory. It is also manufacturing overhead cost. What else? Okay, that are the three that I can think at this time. So remember that. So manufacturing costs are there are three type of manufacturing costs: direct material cost, direct labor cost, and manufacturing overhead cost. So total manufacturing cost equal to direct material cost plus direct labor cost plus manufacturing overhead cost. It means that in accounting, if you are asked to calculate total cost for a product or total manufacturing cost for a product, then the calculation is direct material cost plus direct labor cost plus manufacturing overhead cost. So in this example, in this slide, the example is the sport car, the red sport car. So if there is a question asks you calculate the manufacturing cost for the red sport car. So to calculate the manufacturing cost for the red sports car, the calculation is direct material cost for the car plus direct labor cost for the car plus manufacturing overhead for the car. Okay, there are also another category of costs. It is called non-manufacturing costs. So you can imagine if you have if the business that produces the red sport car is your business, you can imagine that you have a factory, you have the business, and the business has two sections. One is the factory, and another section is the management office. If you have a business, you have to have a management office to manage the business. So the manufacturing costs are costs that happen in the factory, like the thing that you have seen in the previous slide. In the factory, the car is manufactured. You need direct material, direct labor, and overhead. But at the same time, when you have a business, you have to have a management building, a management section. That is where the managers are working. Okay, so in the management office, there are costs that the business has to pay. The costs are called non-manufacturing costs. That is still the business cost, but the costs are non-manufacturing costs. Non-manufacturing costs can be divided into two categories: selling costs and admin costs. Okay, remember this. See the oval and box in the left side of this slide. Selling costs are costs necessary to secure the order and deliver the product. The cost that a business pay to get orders from customers and to send product to the customers are called selling costs. The example of selling costs are advertising expense, salesperson salary or salesperson commission, marketing manager salary. What else? Marketing, advertising, salesperson. Other costs or expenses related to getting orders and send product to customers They are categorized as selling costs. Costs that a business has to pay in the management office other than selling costs are called admin costs. These costs are all executive, organizational, and clerical costs. Things like human resource manager salary, office supplies, what else? Depreciation of the office equipment. They are all admin costs. Management office rental, management office building, property tax, they are all admin costs. So non-manufacturing costs equal to selling costs plus admin costs. So this is the second category of cost that you have to know. Okay, so this is the third category of cost that you have to know. See there are many costs, but there are many types of costs. Costs also can be categorized into product costs versus period costs. Okay, product costs. Product cost equal to direct material plus direct labor plus overhead. Just remember, product cost equal to manufacturing cost. Product cost also known as manufacturing cost. Cost to manufacture something or cost to produce something. Cost to produce a product. So product cost equal to direct material cost plus direct labor cost and manufacturing overhead cost. So if somebody asks you to calculate product cost, so this is the equation. Product cost equal to direct material cost plus direct labor cost plus manufacturing overhead cost. When you prepare the income statement for a manufacturing business, you have to know this equation for product cost. You will use this knowledge when you prepare the income statement for the manufacturing business. Period cost equal to selling cost plus admin cost. So period cost equal to non-manufacturing cost. Non-manufacturing cost or selling cost and admin cost, also known as period cost. Why we call them period cost? Because most of the time, these selling costs and admin costs have to be paid by the business periodically. The business will pay the selling costs and admin costs most of the time every month or every year. For example, the tax for the building, the office building, has to be paid every year. So the cost most of the time has to be paid periodically. So they are called period costs. Product cost, on the other hand, is called product cost because the cost has to be paid every time the business produce something. Every time the business produce a product, the business has to pay direct material cost, direct labor cost, and overhead costs. That's why they are also called as product costs. Okay, so you have learned 3 categories of cost. This knowledge about cost is very important. If I give you a list of costs, you have to know which one is product cost, which one is manufacturing cost, which one is non-manufacturing cost, which one is product cost, which one is period cost, which one is direct material, which one is direct labor, which one is overhead. So you have to know that. So in this example, see here, there is This is a simple question to test your knowledge. See here, which of the following costs will be considered a period rather than product cost in a manufacturing company? So see here, period rather than a product cost. So you remember, period cost from the previous slide, period cost equal to non-manufacturing costs. They are called period costs because most of the time they are paid by the business periodically. So see here, period cost most of the time equal to the non-manufacturing cost. So A, manufacturing equipment depreciation, is it a period cost or product cost? So to answer this question, you have to imagine the cost happen in the factory building or in the management office. So manufacturing equipment depreciation, see, manufacturing equipment is in the factory, so it is not a period cost, it is a product cost. B, property taxes on corporate headquarters. So corporate headquarters is the management building, so it is a period cost. Direct material cost, it happen in the factory, so it is not a period cost. Electrical cost to light the production facility, that is related to the factory, so that is not the period cost. E, salesman commission. Salesman commission is related to management office, so it is a period cost. So there are two period costs, B and E. So that is the thing that you have to know. You have to know, if you are given a list of costs, you have to know the type or the category of each cost. Okay, this is the fourth category of cost. Costs also can be categorized into prime cost and conversion cost. So if there is a question asks you to calculate prime cost, so the answer is prime cost equal to direct material cost plus direct labor cost. Conversion cost, on the other hand, equal to direct labor cost plus manufacturing overhead cost. Okay, see here the logic. Why direct material cost plus direct labor cost are called prime cost? Direct material cost plus direct labor cost are called prime costs because they are the main costs that a business has to pay when the business want to produce something. Let's say you have a factory. Our example is you have a factory that produces frozen food. You will see that to produce the frozen food, most of the time the biggest cost that you will have to pay to produce the frozen food is the direct material cost, the flour, the sugar, the butter, etc., and the labor cost. These two costs are the biggest costs in the production process. So that's why direct material cost plus direct labor costs are called prime cost. And then see here, conversion cost. Conversion cost equal to direct labor plus manufacturing overhead. Why these two costs are called conversion costs? Because to convert direct material to become finished product, you need labor and overhead. Okay, they are called conversion costs because if you have a manufacturing business, you want to convert the raw material to become finished product, you need direct labor and manufacturing overhead. So that's why direct labor cost plus manufacturing overhead cost is called conversion cost. Okay, so now this is another thing that you have to know. in this topic about introduction to management accounting, the difference between merchandising business and manufacturing businesses. Okay, remember this. Merchandising business is a business that purchase finished product from supplier and sell the same product to customer. The simple example for merchandising business is the grocery shop. Grocery shop purchases bread, sugar, rice, etc. from supplier and then sell the same thing to customer. Manufacturing businesses are businesses that purchase raw material and process the raw material and sell finished product. I think all manufacturing businesses are factories. Business like the one that we have so a chocolate factory is a manufacturing business. A chocolate factory purchase raw chocolate, process the chocolate and sell finished product to customer. So see here. Okay, the thing that I have explained can be seen in the two boxes in this slide. See here the orange box and the grey box. The difference between merchandising business and manufacturing business. So when you prepare balance sheet for a merchandising business, the merchandising business has merchandise inventory in its or under its current assets. Merchandise inventory. But a manufacturing business, the manufacturing business has inventories under its current asset, but the inventories can be divided into three types: raw material, work in process, and finished goods. Because remember, manufacturing business has to purchase raw material and then process the raw material and then produces finished goods. So when the manufacturing business close its account at the end of the year, in the inventory there are three types of inventories: raw material, work in process, and finished goods. Work in process, raw materials are waiting to be processed. Work in process are partially complete product. If the business is the sport car factory business, and then if the business close its account at the end of the year, if you check the inventory of the business, they are partially complete cars. So that is called work in process inventory. And there are also finished or completed sport car ready to be sold. So that is called finished goods. Okay, I think I'm stopped here for this first lecture. Do not forget to write your name and matric number in the comment section. That is the lecture attendance for you. I will take that or I will record that as your lecture attendance. Thank you very much.